Why aren't mortgage rates dropping? This is a question that I've been asking myself for the past couple weeks, and it's a question that on the surface seems relatively easy to answer, right? The Federal Reserve hasn't cut their Fed funds rate yet. They haven't begun their rate cutting cycle. So of course, mortgage rates haven't come down. But as I dug a bit deeper into this issue, I found out that mortgage rates, they tend to follow the 10-year US Treasury. And the 10-year US Treasury over the past few weeks has been dropping and dropping relatively quickly. While mortgage rates, they've come down from their 8% high, but they're nowhere near as low as the 10-year Treasury is, as far as the 10-year Treasury yield. So why aren't mortgage rates dropping? We're going to talk about that in this video. And the next question I had as I dug deeper into this is what happens if home prices start to come down? I know that a lot of people watching this video are thinking, maybe hoping that home prices will come down because things are so unaffordable with where mortgage rates are. But if home prices do drop, will we see mortgage rates tick back up? I think there's a very good possibility, and I'm going to show you why right now. But first, my name is Liam O'Reilly. I'm a realtor in Vermont with Jerry Riley Real Estate. If you have any real estate needs in Vermont or anywhere else, all my contact information is in the description. Feel free to reach out to me directly. And let's get into these sources here. So, starting first with, we're actually going to come back to this article with the 10-year Treasury. So, we can see the drop in the 10-year Treasury yield. This is a chart from the past year, and we have the peak at around 5% on the 10-year US note, and it's dropped all the way down to 4.25%, so about 75 basis points or 3/4 of a percentage point. Meanwhile, mortgage rates have dropped from their peak at around 8% to around 7.5%, at least here in Vermont. I know some states are seeing different rates. They're seeing rates that are a little bit lower, but here in Vermont, the 10-year or the 30-year fixed rate mortgage has pretty much stuck at around 7.5% for the best rate that you can get on your mortgage. So this is the best credit score, well-qualified buyers. They're getting around 7.5%. It dropped initially when we saw this first 10-year US Treasury yield decline, but it hasn't dropped much since. So what's going on when we go over here? And I guess one more point on that before we move on, the spread between the 10-year Treasury and mortgage rates is an important thing to note. So, right, they work in tandem. When the 10-year Treasury goes down, mortgage rates tend to follow because the same investors who are investing in 10-year Treasuries are also investing in mortgage-backed securities. But there's still a premium. There's still a higher interest rate that these borrowers, that these investors get when they purchase US Treasuries, or when they purchase, mortgage-backed securities instead of US Treasuries, because mortgage-backed securities, while they're seen as a safe investment, they're still riskier than the US Treasury, right? People say that the US Treasury has no risk of default. Now, that's debatable with what's happened in the recent months, but overall, people can default on their home, can default on their mortgage in that mortgage-backed security, but the US Treasury has never defaulted on its debt, at least so far. So the spread between the US Treasury and the mortgage-backed security is around 1.8, 1.9% as of a month ago. So it's it came down off of its peak, and this article is about a month old, so it's a little bit older. But I bet right now the spread is right around that peak. Actually, we can do the math real quick. I haven't done this yet, but if we look at the US Treasury, 4.25%, and we have the mortgage rate of 7.5%, we're looking at over a 3% premium for mortgage rates, for a mortgage yield on the mortgage rate. Now, this might be a different rate offered to mortgage-backed security investors, but still, there's about a 3% yield as opposed to the zero point 0.6 percentage points of January 2022. Now, one thing to note is that yield, that spread that I just mentioned, I think it is different than what's being offered to the mortgage-backed security market, because lenders, loan originators, the people originating these loans do take a cut of that interest rate. So it's a bit more expensive for the borrower. You pay a little bit more than the return that the investor gets, but still, it's a much higher spread than what we've seen in the past and what we saw in 2022, where the difference between the 10-year Treasury and mortgages was relatively close. And so what's going on? Basically, there's less buyers for these mortgage-backed securities, right? And we've talked about this in videos in the past, but the Federal Reserve, they used to be one of the largest buyers of mortgage-backed securities. And during the pandemic, they were one of the largest buyers. They were buying up mortgage-backed securities, which kept interest rates low and allowed borrowers to get an excellent rate on their mortgage. Now they've left the mortgage-backed security market and are instead letting their mortgage-backed security balance run off. At the same time, they've hiked interest rates, which has shifted deposits from savings accounts and from banks into money market funds, where they're put into U.S. Treasuries and the Federal Reserve's overnight lending facility, where they get a guaranteed rate of return, as opposed to a mortgage-backed security, which is a little bit less liquid and offers a little bit more risk than U.S. Treasuries do. So we have two large buyers that have exited the mortgage-backed security market, one being the Federal Reserve and two being many banks who no longer have the funds to invest into these mortgage-backed securities. And as a result, we're seeing a wider spread between the 10-year Treasury and mortgage-backed securities, right? The 10-year Treasury is dropping. The mortgage rate is staying relatively the same. So why is this important? And why did I mention home prices at the beginning of this video? And if home prices come down, will mortgage rates go higher? And I think there's an argument to be made that they could. So right now, of course, we have our homebuyer housing payment here over in Redfin, which essentially is the affordability of the market. This is the cost that the average buyer would have to pay to purchase the median price home in America, at putting 20% down with no PMI. So that's about $2,600 a month with a 7.29% mortgage rate, so a little bit lower than what we have here in Vermont, but it's relatively unaffordable compared to 2020, which is that gray line, 2021, and even 2022, when things weren't affordable then, but home prices have gone up a little bit since 2022, and mortgage rates are higher than they were this time last year. So if home prices come down, answering that question about why mortgage rates might rise if home prices come down, there's a lot of potential buyers on the sidelines right now. There's a lot of people waiting to buy. Yeah, you might be one of them. You're waiting for a more favorable opportunity. Things are just too expensive. Home prices are too high. It's a very difficult time to buy right now. But say home prices come down. Say home prices drop by 10, 15%. Some of those buyers on the sidelines are going to start coming back into the housing market, going to start transacting, and are going to start making new mortgage-backed securities. Right now, we're at a relatively low period in mortgage-backed security issuance because not many homes are being sold, not many mortgages are being issued. So there's less mortgage-backed securities coming to the market. Even with the low supply of mortgage-backed securities, there's still not that many buyers out there to buy these mortgage-backed securities. So if home prices come down and more of these buyers on the sidelines come into the market and start purchasing these properties, then what we could see is mortgage rates start to rise again because there's not enough investors there to purchase the mortgage-backed securities. So in order to entice more buyers to come to the market, interest rates need to be higher, right? If you get to a high enough yield, then somebody will come along and take their money out of U.S. Treasuries and put it into mortgage-backed securities in order to get this great return that's being offered. So I just think that's something that isn't really being talked about. I haven't heard it talked about anywhere online, but it's something to consider, is that not many people are buying mortgage-backed securities right now. If we see an increase in volume in mortgages being issued, we will likely see mortgage rates increase, right? Because as supply of available mortgage-backed securities goes up and demand stays low, then the price that you're going to have to pay for the mortgages, right? The mortgage-backed security price is going to drop, the yield is going to rise, which is going to entice more buyers to come in to meet the demand that's there. So if home prices drop, we might not see affordability return to normal. At least that is one of the possible scenarios. Of course, nobody knows exactly what's going to happen, but that is a situation that could take place. So anyways, thank you guys so much for watching. Leave me a comment. I'd love to know your perspective on this. Do you think I'm right? Do you think I'm wrong? Let me know in the comment section. Other than that, thanks again for watching, and I'll see you in the next video.